All right, who's ready to learn about being wise in the land of credit and debt? Yeah, I know this isn't as exciting as maybe some of the other topics here, but let me introduce myself. My name is Madeline Wallace, and I have been with FinWise Bank since 2021. I started out in their compliance department, but as of 2023, I have moved into what is essentially their anti-money laundering department. I graduated from Hillcrest High School in 2020 with COVID being around. And I actually graduated from the University of Utah recently with my bachelor's degree in accounting. So go Utes. So you may be wondering why I'm presenting on credit if I'm in anti-money laundering. Well, my bank has in the past presented about credit at this event. And second, a lot of the fraud and whatnot really starts out with the application process and whatnot. So before we dive any further, I just want to give a quick disclosure that the research I've done and the views I have here aren't representative of FinWise Bank as a whole. So we have a lot of on the agenda, but hopefully I can make it interesting for you guys. So we have the important credit terms you need to know, followed by types of credit, different types of interest, some examples with repaying debt, credit reports, and then we'll end with some free resources for you guys. So as I take you on this tour through this strange land known as credit and debt, I think it's important we start out with a roadmap and kind of a legend, if you will, on a traditional map for understanding the various types of credit we'll be going through. So we're going to start out with finance charges, interest, and APR. So these all may sound similar, but there are some differences. So the finance charges are the amount of interest that you have, as well as any loan charges you have over the life of a loan. So using mortgages as an example, you may see origination fees when you have your loan funded, any discount points, which are essentially where you pay a little more upfront to get a little reduction in your interest rate. And mortgage insurance would also be covered under finance charges as well. Next, we have interest, which is the price that you pay to borrow from a lender, or if you have something like a savings account, the money that you're earning on that account. So this does not include, this is separate from like the loan amount or the principal that you may see when you get your disclosures, for instance. And whenever you have a higher interest rate, that means you're going to have to pay more interest. Next is APR. This stands for the annual percentage rate, and you're likely to see this when you see any advertising from like a bank or financial institution. This can be seen as somewhat of a more accurate interest rate, as it also includes additional fees. So some examples of these are like some of the finance charges we've already covered to an extent, like the origination charges. Next, we've got the grace period as well as the late fees. So the grace period is the time in between when a financial obligation is due and when late fees are assessed. It's the time in between that period, and during that time, no late fees are assessed, and you can't go into default or have your loan canceled while that grace period is active. However, you do need to watch out because not all lenders and not all credit products necessarily have a grace period, or their grace period may differ. Which then brings us to late fees. So if, for instance, you don't pay your utility bill on time or whatnot, then you may get assessed a late fee. And if there's no grace period, it may be charged right away, whereas if you have a grace period, it will take place after that grace period has passed. Next, we have cosigner and collateral. So a cosigner is where someone agrees to sign jointly with the borrower on something. So a more personal example I have is when I was in high school, I wanted to get a bank account, checking account, and on my own, I wouldn't necessarily qualify, but one of my parents co-signed with me. So with that, I was able to eventually get a bank account. And that's mainly what cosigners are used for. It's to help qualify someone for a credit product that they may not otherwise qualify for. You do have to be aware, though, if you don't make your payments or if you end up in default, then you will have that cosigner financially liable, and they might not like you very much for that. And then there's collateral, which is something you pledge for repayment. So the most common examples you'll see of this are houses and cars. And not all types of credit have collateral, but some do. And if you default on something that has collateral going on, then the lender can take that collateral from you if you default. Now we're going to go into closing costs, and again, this one relates more to mortgages. So it's the fees and expenses that you have at the end of your home buying. And these fees do not include the home's price. So if let's say you're a real estate agent or you have a real estate agent and they see that a house has a price of $600,000, that does not include these closing costs. So some examples of these costs that you may see include your appraisal fees, any title fees, just to make sure that there aren't any outstanding liens on it that would prevent you from buying the home, the first year of your homeowner's insurance, and any, say, real estate agent fees. There are two costs, though, that are not considered closing costs. So if you've heard of earnest money, that's where you make a deposit. That's where you make a deposit to a seller, to show that you're interested in a home. That's not a closing cost. And then down payments are also not closing costs, because those are where you pay more so that you can hopefully reduce the amount that you have to borrow on a mortgage. So ideally, you'll want a higher down payment because then you'll have less money that's subject to interest. And lastly, for this section, we have default rates. So this is the rate of all the loans that are issued by a lender that have been declared to be in default, and that's usually when a borrower continues to not make payments. And because I'm a math person, and I don't know how many of you are math people, but I have a formula here. You take your defaulted loans divided by your total number of loans, and then you multiply that result by 100. So why are we even talking about default rates? Well, they actually give a glimpse into the overall health of the economy. So if there's more people that can't make their financial obligations and more of those loans are defaulting, then that doesn't look really good for the economy, does it? So you may notice that, oh, yes?
At your bank, what would the current default loans be right now for this month? Can you give us a number?
I unfortunately don't have that information. I'm sorry.
Do you know if that is trending up or down?
I would guess trending up just because the economy, with the interest rates having increased and whatnot, I would imagine that they have gone up. So as to continue with default rates, some lenders and even some credit products have different default rates. So some may have higher rates, some may have lower rates. It just depends. And on the more personal level, if you default, then it has quite the negative impact on your credit score. And we'll be going into that later in this presentation. So now that we've got the roadmap out of the way, we're going to dive into some of the more common types of credit you may see. And to help demystify some of this, I will be having a picture of an animal on each slide, just kind of as a metaphor. So we're going to start first with unsecured credit. And the reason I have a frog up here is, frogs are small. Unsecured credit, likewise, isn't usually for your big loan amounts. And the reason why it's called unsecured credit, if you're wondering, is because the credit that you're using is not secured by collateral. So no collateral with this one. As such, your personal property is usually not at risk. And these are usually they're usually simplified compared to secured credit applications. So you may find that those that unsecured credit gets approved more quickly. You may also have more flexibility in what you can use the funds for. So if you have a car loan, for instance, you might be limited to just using those funds on car expenses, whereas you don't have that limitation with unsecured credit. There are some disadvantages, though. For one, if you default, you are likely to get sent to collections. And this is true with multiple types of credit. And collections can be kind of annoying when they call you asking for payment. So if you can, try to avoid defaulting on your credit. Also, your loan amounts aren't usually as high. And you may see that you actually have higher interest rates here compared to secured credit. And did you have something to say?
Yeah, just a quick question. Does your bank does a person review these applications, or is it like an algorithm?
So we have strategic partners. I'd say for most of them, it's reviewed by a person, but there are some, I think, that do have that algorithm that contributes to the decision making.
Thank you.
You're welcome. I lost my train of thought, but on secured credit, there's with the collateral usually provides some risk mitigation or whatnot for the lender, but because there's more risk without that collateral, the lender will likely want a higher interest rate on unsecured credit. Next, we're going to go into secured credit, which I have a bear here because for some people, the risk of having that collateral taken can be rather scary. So here you'll find higher loan amounts and for the most part, lower interest rates compared to your unsecured credit, mainly because of that collateral. And also because collateral provides some level of protection for the lender, you may find that it's easier to qualify for some secured credit. However, the lender can come after your personal property. That's that risk of collateral. The applications are usually more complex, so it may be a while before you hear back from your lender. And you may also end up paying more interest in the long run with those higher loan amounts. Next, we have revolving credit, and there's a kangaroo here because each balance is kind of like what you use on each time you use revolving credit. It's not based off the whole kangaroo. For the advantages, the interest that you're charged is only based off of the amount that you use. So if I have a $5,000 balance that I can use, but I only use 1,000 of that, then that interest only applies to that 1,000. You can also build up your credit history if you use it properly. You just have to be careful to make your payments on each time you use it. And there's generally more flexibility on accessing the funds when you need them. For your disadvantages, though, these tend to have higher interest. You're looking at maybe 20 to 30%, if not more, especially if you still have a balance that remains or if you don't make your payments on time. Next, you also have high credit utilization that you can potentially be exposed to with revolving credit. And what this means is out of however much you're allowed to use, you use a lot of that. So again, with 5,000, if I spend 4,999 of that, that's going to be more than if I spend 2,000 in terms of that credit utilization, and that hurts your credit score, as we'll go into a little later. Additionally, revolving credit can charge annual fees even if you don't have a balance. Next, we're going to go into credit cards, which are a subset of revolving credit. I have a sloth here because credit cards are definitely convenient, but you don't want to be too much of a sloth and don't let those high interest and whatnot catch up to you. So they're convenient so credit cards are convenient for everyday usage. Like, for instance, when I have to pay for gas, I tend to use my credit card. There's generally more consumer protections on these compared to debit cards. So debit cards are usually linked to your bank account, and the amount that you can use is based off of your balance in that bank account, whereas credit cards are separate. Additionally, credit cards have more fraud protection. So let's say if someone managed to get a hold of your card and started making a bunch of charges on it, you have more recourse with a credit card than you do with a debit card. Additionally, credit cards have reward systems. So if you see like 1% cash back off of all your purchases, or a higher percentage off of certain purchases like restaurants, then that's that reward system. The convenience does come with its downsides, though. It's easy to overspend if you're not paying attention to your balance. And if you use too many credit scores, or if you have too many, then that hurts your credit score under that high credit utilization. And you may, when you're seeing ads for credit cards, you may see these teaser rates. For instance, 0% introductory APR. What you need to be careful of is you have to look at the fine print to see how long that rate lasts for, and B, if you have charges that you're accumulating because, hey, there's no interest, I might as well get all these charges on my card. Once that teaser rate ends, then you're going to have that high interest that you need to pay back. Next, we've got installment loans, and there's a rhino here because these are known to have higher loan amounts. Additionally, you can refinance these and potentially get better loan terms. Again, that's not necessarily a guarantee. I mean, the economy right now, you may have noticed interest rates have been going up. So you may not want to refinance right now because the chances of you getting a better interest rate are not as high. Additionally, installment loans have fixed payments for the most part. So if you're into budgeting, that makes it easier rather than trying to figure out, okay, what percent of this might go to this. You just know straight away. Each month I have to pay $1,000, for instance, on this installment loan. And as I was alluding to with the rhino, you can usually qualify for higher credit amounts. For disadvantages, though, one of the bigger ones is the prepayment penalties. So let's say I have 15 years to pay off an installment loan, but I instead pay that off within 10 years. Since I paid that off early, my lender may charge me a prepayment penalty, and you just have to be aware of that if you decide to pay off something like this early. Additionally, because these are for longer time periods, you're likely to have more interest, and if you need any additional funds, you need to reapply or refinance to get those additional loans or get those additional dollar amounts. We've got mortgages next, and they're a subset of installment loans. And the elephant here is for most people, I would believe that they would find homes to be their largest expense. And, elephants are pretty huge as well, so they just kind of go together. On the advantages, you usually have more time to repay. So the most common terms are 15 to 30 years. Home ownership can be more attainable because you're not going to see a lot of people coming in with an all-cash offer, especially as home prices go up. And because these are based off of homes, they have higher dollar amounts that you could be approved for. As for disadvantages, again, you've got that interest component to keep in mind. Did you have a question? Oh, sorry. If you default, that property that you have a mortgage on can be repossessed and potentially, for instance, go into auction. And there are multiple associated fees with mortgages that are not specifically tied to the mortgage itself that you have to be aware of. And we already talked about some of these, like the closing costs and the down payments. Next, we have student loans, and I have a vulture here because you may have been hearing in the news about some lenders and institutions taking advantage of these student loan borrowers. Not that all institutions or lenders do, but there have been definitely some bad apples. For advantages, you don't need to have much of a credit history to qualify. You don't even have to have a credit history. Higher education can be more attainable if you can make the payments, but unlike mortgages, whether it's actually more attainable depends on the situation. And you may also have the option to choose between federal and private student loans. So while private loans may have a lower APR or interest rate, federal student loans tend to have more programs when it comes to like trying to get your loan forgiven or whatnot. So there's a couple of programs out there. I want to say there's one for like government workers, one for teachers, and so forth, where they can either reduce the amount you have to pay each month or even forgive your loan outright. For disadvantages, there are, because of the payments on some of these, you may not be able to reach your other financial goals as timely, like if you want to buy a house. The loan amount itself may not cover all your educational expenses, so that is where I would recommend looking into other sources of funding. So you may see grants or scholarships, and there's the option of working while you're in college. I know for my experience, at least, I used scholarships and working to help finance my education. Additionally, unlike some forms of debt and credit, student loans are harder to discharge in bankruptcy. There's a certain standard known as the undue hardship standard, and I'm not going to go into all the details on that here, but suffice to say it's a pretty difficult standard, and not a lot of people are going to usually meet that. So even if they go into bankruptcy, chances are they'll still have to pay on their student loans. And last for this section, I have payday and predatory lenders. So the snake here represents how some lenders may lure you in with how easy it is to get your funds, but then the interest rate bites really hard. So as I was just alluding to for the advantages, you've got that ease of access if you need short-term funds or if you have an emergency come up. Like did you have a question? Yeah, no, okay. Like if you have your car break down and you don't have money to pay for that, then that's kind of the situation these are for. Additionally, the applications are simpler and faster to process. You may have even seen lenders advertise for like same-day approval. And they don't care as much about your credit history as some of the other credit types we've discussed. So you can potentially get approved even if you have bad credit. However, there are definitely advantages with this type of lending. These easily have the highest interest rates of the credit types that we have here. You can easily see these go into the hundreds for the interest rates, just to give an idea on that. Some of these lenders also target low-income or minority communities who may already have a hard enough time paying these types of loans back. And because of the two disadvantages I just described, you may not be able to find these lenders in your state. Some states have restricted or outright prohibited these types of lenders. And one of the ways they do this is through an interest rate cap. So Utah, for instance, does not have an interest rate cap. But other states, like California, for instance, may have a cap of 36%. And if you as a lender go above that interest rate cap, or even if your APR is above that cap, then technically speaking, your contract with the consumer is null and void. Okay, we're going to start getting into some of the math here, and we're going to be going into the differences between simple and compound interest. So for simple interest, it's the loan that you are either charged or that you earn based off of your principal and an interest rate. So I have the formula up here from Google, as you can see. But in words, it's essentially your principal times 1 plus your interest rate on an annual basis and however many years. So in this example, with $10,000 for 1% at 30 years, we're looking at $13,000 at the end of those 30 years. So not bad, as opposed to just leaving it somewhere where there's no interest that accumulates. You're likely to see simple interest with mortgages, car loans, and some certificates of deposit. With CDs, these are essentially, they have higher interest rates than savings accounts, but the thing is, once you put that money in, you can't pull it out for a certain period of time, like 6 months or a year. And if you do try to pull it out, you have to pay a penalty. So I was going to put in some Excel tables in for this section, but having all these years out might be a little difficult to read on a PowerPoint, so I opted for a graph instead. So with this example, if we're looking at $3,000 for our principal at 5% interest for 30 years, you can see at the end we end up with $7,500. Now this may not be as bad if you're just trying to pay money on something that's earning simple interest. This is obviously, simple interest is more ideal for when you're paying something that has that interest, as opposed to if you're wanting to earn money. So if you're wanting to earn more money, how do you do that? Well, that's where compound interest comes in. So it's similar to simple interest, but you also have that prior interest considered into your calculation. In other words, the interest on interest, as you may have heard. You may see that I have the formula up here, again, this time from Google. I don't have the n necessarily listed out here. We're just going to assume for this example that we're compounding annually or one time. Essentially, your n is how many times you compound annually, but if it's at 1, essentially, you don't have to worry about the n, but only if you're doing annually. So you're going to take your principal times 1 plus your annual interest rate, and your exponents, however many years have elapsed. So with that 10,000 example, you can see we're now at 13,478 roughly, which is more than the 13,000 with the simple interest. You're likely to see compound interest with credit cards, savings accounts, and money market accounts. Money market accounts have higher interest than savings accounts, but tend to be limited in how many transactions you can use them for each year. Here I have 2 graphs, one for annual compounding and one for monthly compounding. With our annual compound, at the end of 30 years with 3,005%, we have $12,966 roughly, whereas with monthly compounding, we have $13,403 roughly. So whenever your compounding interval is not annually, like if it's quarterly or continuously, then that n is going to become important. And here I've labeled it as the compounding interval. So you can see, yes?
This last year, as a class, we did a little bit of research, and we found that most banks and credit unions are compounding annually but paying monthly. And that's a little bit deceiving to the kids. Could you comment, are there accounts at your bank that truly compound monthly and not just pay monthly, as opposed to compounding annually but paying monthly? Does that make sense?
Yeah, I don't necessarily have that information.
Are you aware of any accounts that compound monthly?
I am not aware of any I'm not aware of those accounts, no.
Thank you.
Where was I? When you compound more frequently, you can see, like with this example with the 10,000, that you will have more money in the long run, and that's where the power of compounding comes in. When you have, like, for instance, more time, a higher interest rate, or even a higher amount that you start with, you're definitely going to see a difference with that. Next, we're going to go into repaying debt and be ready for more graphs. So let's think about, say, a credit card, and my bill comes in, and my dollar amount the amount that I've used is $2,500. And because this is a credit card we're talking about, it's a higher APR or interest rate at 28%. If I wanted to pay off that full amount within 60 months, assuming I don't accumulate more debt with that card or through other cards, for instance, I'd have to make a minimum payment of $78 a month for 60 months or 5 years. If you look at the first graph, which is for not making any additional payments, you can see for most of the time, the amount that's applied towards interest is on these payments is more than the amount applied towards principal. But with the second one, you can see that almost right away we start with more of the payments going towards the principal. And that's because we're making additional payments, in this case, doubling our payments. And because of that, we now are at 20 months to repay this balance as opposed to 60. And I actually have an example, not necessarily with a credit card, but with a mortgage. So when my parents bought their house 20 or so years ago, prices were obviously a little less expensive, and they were able to qualify for a 30-year mortgage. And they used that just so they'd have a cushion in case, for instance, one of them lost their job. They ended up making extra payments, and they ended up paying off their mortgage within roughly 15 years as opposed to 30. Speaking of mortgages, let's consider, yes?
On the previous slide, you had minimum payment of $77.84, but then down below it says extra payment of $77.84. So is it the minimum, or is it you pay an extra in addition to the minimum payment?
So on that one,
I think you said you doubled it.
yeah, so if the extra is for if you wanted to pay it off sooner.
Okay. I missed that when you said that. So you would essentially be paying $160.
Sometimes if you pay it midweek, it restarts your interest payments. Your interest accumulation goes right up to the top of that. So if you have a 30 and 15, restart your interest.
Okay, let's see, with the installment loan one, which a mortgage is essentially an installment loan. If we look at the house market today, you may see that it's pretty expensive. And the reason I know some of this is because one of my parents happens to be a broker. So she's gone on the MLS and whatnot and looked at home prices over the last few years. Let's say your mortgage is for $620,000, and because interest rates have been going up, let's say your interest is at 7%. If you're wanting to pay that off within 30 years, you have to make a minimum payment each month of roughly $4,125. Without making any additional payments, it takes you that full time. But if you even make a smaller extra payment so that you just slightly increase how much you're paying each month, you can see here it takes about 28 or 29 years. So that does save you some time and money. If we go to 15 years with the similar terms, our minimum payment has bumped up now to $5,528. And it's a little bit harder to see just because the minimum payment is so high. But with making even a small extra payment, you do shave off a couple of months on that installment loan. So the examples that I touched on focused on just looking at one particular type of credit or whatnot. So what if you have multiple going on at the same time? Like you have a credit card and a mortgage and a car loan and whatnot. You may want to consider these two methods. The first one is practically endorsed by Dave Ramsey. You may have heard of him. Essentially, you take all your debt except for your mortgage and figure out what's smallest to largest in terms of your dollar amount. And then you make minimum payments on all of them each period except for whatever your smallest is, in which case you make extra payments. So the advantages with this one are that it's easier to see the progress that you're making because you can see, hey, that $2,000 credit card debt has been knocked out and whatnot. And it can help you adjust your financial behavior. But the interest itself can stack up because you're not considering the interest rates when you're trying to figure out which one should get the extra payments. And the other method is the debt avalanche. And it's similar in approach, but instead you're looking at interest rates and you're sorting them by highest to lowest. So whatever one is your highest interest rate gets extra payments while the rest get minimum payments. And while you can potentially save time and interest, it takes longer to see any progress, and that may deter people who don't have that self-motivation to really see it through. The good news is we're done with all the math. I know some people may not like the math very much, so we're going to dive more into credit reports now. So here I've got a lion because the three names you see here are considered the major credit bureaus, and they're like the kings of the jungle, if you will. So most lenders report to at least one of these three, and the three are TransUnion, Equifax, and Experian. And each of those credit bureaus calculates their credit scores a little differently. I won't necessarily be going into those differences here, but they may weigh more importance on some factors compared to others. For instance, you may see one puts a higher emphasis on your credit utilization, while another puts more emphasis on your length of credit history, like how long have you had credit cards or mortgages, that type of thing. Additionally, they may also report different items. So within the past year or so, Experian actually started reporting on rental payments. And with that, if you take a Experian credit report and you look at a credit report by a different credit bureau, you may see a difference in your credit score just because of that. So each year you can actually get a free credit report from this website known as annualcreditreport.com. I'm not going to try to go through all of it here just for time, but essentially, while there are other websites out there that say they give free credit reports, they may be scams. So you just do this website, don't do the others. And during COVID-19, they were allowing free weekly credit reports, and it's a little confusing on their website whether this still applies, but you may not necessarily want to be getting a free credit report weekly just because it counts as an inquiry on your credit report, and having too many inquiries can hurt your credit score. So when you're using this website, be sure to not just use all three on the same day. Maybe have near the beginning of the year where you look at TransUnion, the middle of the year you look at Equifax, and so forth. And when you get these credit reports, make sure you look for any changes in your information and accounts and file a dispute if something doesn't seem right. So in a credit report, you're likely to see a credit score, and these are actually very important. So why should even students care about credit scores? Well, one, they determine your availability in terms of getting credit. Certain credit types or lenders may not take lower credit scores. So you have to just kind of be aware of that as you're shopping for financial products, let's say. And when you're borrowing, when you're borrowing, the interest that you have to pay may be lower when you have a higher credit score than if you have a lower credit score. And this is because lenders see this credit score as an indicator of financial behavior and financial responsibility. And it's not just lenders that necessarily look at the credit scores, but other companies like insurance companies, for instance, they may pull your credit, which is essentially inquiring about your credit report, and then they may give you more favorable terms depending on your credit score. We're going to go next into the key components of a credit report. So the key sections you'll find are your personal information, so like your name and date of birth, any public records on you, like bankruptcies, any collections. And then these next two are pretty important when it comes to an inquiry, or when it comes to a dispute, like if something's not right. So any trade lines or credit accounts that you have, as well as companies that have been inquiring on your credit report. So if those don't line up with what you've filed for what you've applied for instance, then be sure to get a dispute on those. Derogatory remarks are negative items that can hurt your credit score. So you're looking at like late fees, missed payments or late payments, charge-offs, bankruptcies, and repossessions. And charge-offs are when, say, if you continue to not make payments on something for 6 months, the lender may charge it off on their end for like their financial books, but you're still technically liable. These derogatory remarks can be removed over time. I believe it's 7 years, just for the passing of time that they can get dropped off. Or if you file a dispute for something that, say, is the result of identity theft and the credit bureau finds in your favor, then that derogatory remark may be removed. Next, we have credit abuse, and I know we're running low on time. Have this chameleon here just because they try to take your identity and, make your life miserable. Credit abuse is where an individual does not get the consent of a borrower to do something. So they might open a fake account in your name, or they might steal your existing accounts or loans. So like if your bank account has ever been hacked, the scammer could go in and try to change not only your login information, but your contact information, so you're locked out of the loop. So here are just some warning signs to be aware of. You'll want to watch out for late fees, missed payments, and collection notices, as well as bounced checks or non-sufficient funds for when your balance is not as high as you think it is. As well as any authorized charges on your account and any unfamiliar accounts and inquiries on your credit report. And then just a couple more slides. We have our resources and closing. So we've gone through this journey, and just to kind of close, I've got some free resources I found for you guys. You may have heard of Next Gen Personal Finance and Junior Achievement. They're both actually at this summit, so if you've not been to their presentations, check them out. The other resources I have are Money Prodigy, Bonsai, Intuit for Education, Everfi, and Teach FinLit. So I think we're out of time, but if you have any additional questions, you can reach out to me at mwallace@finwisebank.com. And if you go to Sched, or however you pronounce the scheduling platform, I have the presentation as well as the spreadsheets for the graphs on like the interest and amortization. So I know you're probably all looking forward to lunch, so let's. So I just want to thank you all for letting me come present to you today, and I hope you all have a happy lunch.